Now, the interesting part is that guys like Warren Buffett will swear that over the long term, that owning stocks is the best inflation hedge. Because let's say you're Coca-Cola and inflation destroys the half of the purchasing value of money and over, let's say, 2 decades. Well, over 2 decades, Coca-Cola will go from charging $3 a Coke to charging $6 a Coke. And so what happens is that they're going to sell the same amount of Cokes and they're inflation protected because as inflation was running higher and their money was losing value, their revenues and earnings were actually growing, and the company's value is therefore actually being hedged by inflation. So owning these long-term assets, it pays dividends and is an structural inflation hedge. And so a Warren Buffett will tell you stocks are a great thing, but there you have to own stocks at right prices. And so when we're in a bubblish environment where something is trading 50 times sales, uh, there's a point where that theory won't work because that stock could theoretically lose 80% of its value and still be a good functioning company, right? Like the thing is that in order for Warren Buffett's theory to work, is you have to be buying those stocks at fair valuations and holding them over a long duration period. And clearly, in today's market environment, you have to believe that stocks are incredibly rich in their prices, and so the allocation to the S&P, I would say, should be lower now and higher in the future when there's an opportunity.
Now we're going to go over to the school platform, or Rebel Capital's Pro, excuse me, community. It's just the investment community, the private investment community I have with Lynn Alden and Chris McIntosh and Brent Johnson, Patrick Sresna, Jason Harmon, et cetera. It's right there. But anyway,